Okay. Alrighty, hello everyone, and welcome to the workshop. My name is Jillian Baldessari. I'm the Program and Events Coordinator at the Staten Island Chamber of Commerce. Today we're having the first-time homebuyer workshop of COVID-19 related home ownership issues. And we are featuring the panelists of Azalea Capers, Staten Island Legal Services, Peter Chace from TD Bank, and Sara Manaugh from Staten Island Legal Services. Okay, Peter, if you'd like to say a few words.
Thank you. Thank you, Jill. It's a pleasure to be here. It's a pleasure to have participated in the series this fall, helping first-time homebuyers learn more about the process. It's nice to be here with Sara and Azalea, and I'm interested to hear what they have to say about COVID-related issues when planning to buy a new home. I do have a number of things I'd like to share with the participants at the right time. Maybe you could circle back after Sara and Azalea have talked about what I'm seeing, how buying a home is impacted during the time of COVID, things you can expect around documentation and the process up through closing.
Yeah, sure.
I just wanted to say that TD Bank is committed to helping first-time home buyers, and as am I. And if anyone is interested in buying a home and needs help with arranging the financing, to please reach out. Thank you so much.
Great, thank you, Peter. Okay, girls, go ahead.
All right, well, thank you, Peter, and thank you, Jillian, for inviting me and my colleague Azalea to present today. We won't be presenting on home buying issues because our practice is helping homeowners who are struggling, and typically, that's an issue that has to do with a lot of more individualized circumstances. But now, of course, in light of the global pandemic, a lot of people are facing the same issues or similar issues. And so we're kind of going to be talking about that and the systemic responses of government and the industry to these issues. And I'm going to go ahead and just share my screen, bring up our PowerPoint. It seems like it's disabled, so I don't have the ability to share my screen right now. Jillian, I don't know if you're able to change the settings for me. I can just go ahead and begin presenting, but if that becomes possible, I'm just getting the message that I'm not able, because
Sara, I'll pull it up on mine and then we can present from there. Everybody,
okay.
Just a second.
All right. I may also just tell you about tell you when I need to change the slide. So
Okay.
Okay.
Alrighty, 1 second. Okay. Okay. Alrighty. Just give me 1 sec. Okay.
Excellent. So you can scroll to the second slide.
Okay. And we're going to play from current slide. Okay. 1 second. Alrighty. Here we go. Sure. Hold on 1 second. Okay. Alrighty. Everyone see it? Okay. Can everyone see?
Yes, I can see. All right. So as an initial matter, there are a lot of hardships that a homeowner might experience relating to COVID-19. Some of them very direct, such as actual illness from the virus, hospitalization, hospitalization of family members, household members, but they can also be attenuated and indirect effects. So all of the hardships listed here are ones that we see fairly often. losing employment, unemployment benefits not kicking in, and as many people know, the Department of Labor is inundated with requests, and it's extremely hard to get through. So the income stream might be interrupted indefinitely. Having to stay home to care for a sick family member. A big issue facing homeowners who have 2 to 3 family properties is that the income stream that they relied on from their tenants is interrupted because the tenants have lost their jobs, can't afford to pay rent. Family businesses, small businesses may not be getting the income that they need to keep the family finances in order. Family members may not be able to contribute. Of course, kids being schooled remotely often means that family members just can't work as much as they had been, so may have reduced income from employment. Increased expenses due to the need to buy a car, to use Uber or Lyft instead of the subway, and of course, childcare issues relating to lack of availability of babysitters and nannies and so forth. So those are all potential hardships. They aren't. It is not an exclusive or a comprehensive list. It is just the most common ones that we've seen. Next slide, please. So a homeowner who's suffering a hardship from COVID-19 has some options, and the most common and possibly the most helpful for someone who's suffering a temporary hardship because of COVID-19 is a forbearance. So explaining sort of what a forbearance looks like, but that is, it's in effect a reduction or a suspension of mortgage payments during the pendency of the hardship. So you may, if you're seeking a forbearance from your loan servicer, you may need to provide proof of that hardship. You may not need to provide proof of that hardship. You may get a suspension or a reduction in payments for only a few months. You might be able to get it for as much as a year or even more, depending on whether current federal regulations and statutory frameworks are extended. So next slide, please. So a forbearance means you simply don't have to pay for a period of time, or maybe you pay a reduced amount. And if you're paying less than the usual monthly amount of your mortgage, or you're not paying it at all, if you're in a forbearance, you don't get charged fees, penalties, or extra interest, and you wouldn't be deemed to be in default. You wouldn't be threatened with foreclosure. And you would not be reported to the credit reporting agencies as being in default unless, and this is important, if you were in default before you got the forbearance, you would still be reported to the credit reporting agencies as in default. So your credit report will show that you're in a forbearance if you are in a forbearance, but it doesn't affect your credit score, and it really shouldn't affect your credit worthiness, although time will tell. But that's the idea. The issuers, the lenders, have to report the forbearance, but shouldn't be reporting it as a negative event. All of that said, if you're in a forbearance, you're not making payments. Those payments are not forgiven. You'll have to repay them. Next slide, please. So how can you get relief if you are suffering a COVID-19 related hardship? You should definitely contact your mortgage servicer immediately. Not surprisingly, the servicers are also inundated with a lot of calls from borrowers who need relief, and so their lines are overloaded. You'll have to be on hold for a long time if you're contacting your servicer. It's difficult to get through any other way besides the phone, so that's sort of the option. It's important to reach out as soon as you know you're going to need help by way of a suspension of payments. It's also really important to find out who owns your mortgage. And most of us now are aware that the servicer, the company that sends our bills, is typically not the same company that owns the loan. And so finding out who owns your loan is important for a couple of reasons that we will be talking about. So those are two really important things to do first and foremost if you need help. Next slide, please. The main reason that it matters is that there's sort of a dichotomy between federally backed loans and non-federally backed loans. So if your loan is owned, insured, or guaranteed by Fannie Mae, Freddie Mac, FHA, VA, or USDA, yours is a federally backed loan, and it's governed by the HEIRS Act, which was passed at the beginning of the pandemic by Congress. If your loan is federally backed and you've suffered a COVID-19 related hardship, you're entitled to at least 180-day forbearance. And if you call your servicer, if your loan is owned or insured or guaranteed by one of those entities, and you tell your servicer that you're suffering a COVID-19 related hardship, you should be entitled, without having to provide documentation, to a forbearance of at least that long. This is the last month for requesting a COVID-19 related forbearance. We expect that to be extended, but it hasn't been extended yet. So the clock is ticking on that. And if you anticipate that you're going to have trouble paying your mortgage, even if you're current now, it's a really important time to try to request that forbearance. Next slide, please. Now, if your loan is not owned, insured, or guaranteed by one of those entities, it's New York State's COVID-19 relief program that applies to your loan. And those protections are different and lesser, but there still are protections. So a servicer of a non-federally backed loan, one that's regulated by the state, still must make forbearance widely available to borrowers who can demonstrate a COVID-19 related financial hardship. Servicers of those loans have to provide an application process upon request and within a couple of weeks, 10 days. You may need to provide documentation of your hardship, and that's something you just don't have to do if your loan is federally backed. And the kind of proof that you need to provide is not, there is no sort of set of required documents. It depends largely, of course, on the kind of hardship you have. But a New York forbearance has to be at least 90 days. That's half as long as the required minimum amount of forbearance provided under the federally backed loans. And that is not to say that you would have to take any particular length of time. If you don't need 90 days, you don't need to take it. If you don't need 180 days, you don't need to take it. But that has to be offered to you. And the federally backed loans must be extended by another 180 days at your request. Next slide, please. So there is a way to find out if your loan is federally backed or not. The Fannie Mae and Freddie Mac websites both have lookup tools. So you can simply Google, does Fannie own or does Freddie own? That's typically how I get into the system to search for one of our clients' loans to see if they're federally backed. Easy to do. That will bring you to the lookup tool for either Fannie or Freddie. Type in your address, type in the last 4 digits of your social security number, and you'll be able to find out whether your loan is owned by Fannie. And then if Fannie says no, you can search Freddie. If Freddie says no, then you know your loan isn't owned by one of those government-sponsored enterprises or GSEs. If your loan is FHA insured, you can find that out fairly easily by looking at your mortgage to see if it has an FHA loan number at the top of the first page. You may not have your mortgage lying around, but the mortgage is a publicly recorded document. So you can go to the here in Staten Island, on Staten Island, the Richmond County Clerk's Office has land records that are publicly available. So you can go there and search under your name for all the publicly recorded documents related to your name. You can find your mortgage, look and see if it's FHA insured. You may already know that it is, but if you don't, that's how you find out. You can also ask your servicer. If you get through to your servicer on the phone, you can ask your servicer who owns your loan. It is not uncommon for the servicer representative not to be able to provide that information to you because they may not know and they may not be well trained to find out that information. Worst case scenario, you send a qualified written request to your servicer to ask who owns my loan. They need to provide that information to you within just a few days if you send that in. The address for sending in a qualified written request is on your statement or on the servicer website. A qualified written request, that's a term of art. That's a federal sort of, that's subject to federal law. If you send in a qualified written request at the address provided by the servicer and identify your request as a qualified written request, they have to answer you within just a few days. You may be able to mail it, or you may be able to email it, or you may be able to fax that information. And you may be even able to do a qualified written request by phone, but see my prior comments about how hard it is to get through to your servicer on the phone. So next slide, please. So if you're in a forbearance, if you request one and receive one, and you're able to suspend your payments for a period of time, you still may make payments. You aren't going to waive or cut short your forbearance period by making payments. And if you're able to make those payments during the forbearance, it's a good idea to do that, largely because you're going to have to pay those payments back anyway. If you miss them, you still have to make them later. So if you can reduce the amount of forborne debt, that's a really good idea to try to do. Your servicer is going to continue to send you statements and notices during the forbearance period. It's a really good idea to keep track of what they're communicating to you. They may, for instance, even if you've got a federally backed loan, you're in a 180-day forbearance, the servicer still may want you to confirm after 90 days that you're still interested in the forbearance. They can't really kick you out, but it's much better for you to confirm with them that you would still like to stay in the forbearance for the full 180 days. You certainly don't want the forbearance to end without renewal if you're eligible for renewal and you need it. If you come to the end of forbearance, don't renew, and then you aren't making payments after that point, you could certainly end up in default, and foreclosure could follow soon thereafter. So it's really important to keep track of that. While you're in forbearance, think about how you would need to get out of forbearance after the period is over. How do you pay back those forborne payments after your forbearance period ends? That's something that, of course, I'll be explaining, and Azalea will be explaining. But just keeping track here. We at Legal Services can certainly help with, we provide services to low-income Staten Islanders, and a lot of our clients now are people who are in forbearances and who are trying to plan for what happens when their forbearance period ends. So we can go to the next slide. And just as a matter of sort of covering all the bases, most of the people in forbearances are people with forward mortgages, regular conventional mortgages, where they are getting a suspension of their principal and interest payments and also their escrow. So reverse mortgage holders, though, also, or reverse mortgage borrowers, also can get forbearances. Obviously, they look a little bit different because a reverse mortgage borrower doesn't have to make principal and interest payments. However, they do need to keep up with property tax payments and insurance premiums and their water bills. And if for any reason they're not able to do that, they need to also reach out to their servicers and to make sure that the servicer knows that they're experiencing a COVID-19 related hardship. So they don't end up in a foreclosure, which is sometimes what a reverse mortgage borrower will experience if they don't make those payments. Various events can cause default for a reverse mortgager, and that can be a problem for anyone who's experiencing a hardship. If someone can't keep up with those bills, if they can't keep their home in good repair, and if they are, for instance, ill and aren't living in their home for at least half the year because they're in the hospital or in a rehab facility, all those things can cause default. So it's really important that anyone suffering any of those situations reach out to their reverse mortgage servicer to avoid default and stay in a safe sort of forbearance period. Next slide, please. So a reverse mortgage borrower who requests help can get an extension of the period that ordinarily would start immediately upon default. They can get at least 6 months and up to a year of deferral of the request of the servicer to HUD for permission to start a foreclosure. So in effect, if a reverse mortgage borrower is in a default because of failure to pay property taxes or insurance, failure to keep the home in good repair, failure to be occupying the property, all of those things can lead to a default. Servicer ordinarily could immediately reach out to HUD to ask for permission to start a foreclosure. A forbearance allows the borrower to ask that that period be suspended for at least 6 months to a year. And if the borrower is sick with the virus and ends up dying of the virus, homeowners' families and their heirs can ask for more time to deal with the property for a period of time as well under these rules. But the deadline is the end of this year, the end of this month in effect. So if anyone is in need of help with that sort of thing, that's something that either Staten Island Legal Services or a housing counselor could assist with. Next slide, please. So after a forbearance period is over for a reverse mortgage borrower or a forward mortgage borrower, you certainly need to be aware that any forborne payments, anything that hasn't been paid during that forbearance period, does need to be paid. And that needs to be worked out with your servicer. Your servicer may, if you're a reverse mortgage borrower, may have paid your property taxes and insurance, and you need to work out a plan to repay those things. If you've got a regular mortgage and you haven't made your regular mortgage payments, you need to figure out how you're going to repay those. Now, it's important to know you're not required to pay all of those amounts back as a lump sum at the end of a forbearance period if your loan is federally backed. And really, if it's one of these New York COVID-19 relief kind of forbearances, you also really shouldn't have to pay it back in a lump sum. There should be a way to work out a repayment that doesn't require that kind of draconian repayment arrangement. But they may ask for it, and you certainly should try to negotiate with them if that's not an available option for you. That's something that we would be able to help to negotiate as needed for someone who's eligible for our services. All right, I am going to turn slides over now to Azalea.
Thank you, Sarah. Okay, we're just going to go over repayment options for once the forbearance period has ended. Deferral means that missed payments are stuck onto the end of your loan. Fannie and Freddie will not charge interest on deferred amount, but other lenders might. Your payments may still go up after deferral because the escrow portion, your missed payments may not be deferred, and you may need to catch up on the shortage. The servicer might offer you a deferral if you submit an incomplete modification application. Next slide, please. Continuing, COVID-19 partial claim may be available to FHA insured borrowers, and it is like a deferral, but it is secured by a second mortgage that is recorded. You may not be able to get a COVID-19 partial claim if it is in the past that you have received a partial claim as a part of your modification of your of FHA insured. Lump sum payment. All missed payments are repaid at one time after the forbearance period. If you have a Fannie, Freddie, or FHA, they will not require a lump sum during the repayment period. Lump sum repayment is generally not a good option, even if you are able to raise those funds, and probably it's not your only option as well. A repayment plan allows you to pay back missed payments over a period of months. For reverse mortgage borrowers, a repayment plan can be used to pay back your servicer any amounts it paid toward your property tax or homeowners insurance. Servicers may each have their own repayment programs. So one servicer may offer a 6-month repayment plan, another may offer a 12-month plan. A repayment plan may work if you can afford to make your regular payment plus the repayment amount. You should not agree to a repayment plan if it would be a hardship. Modification is another option of repayment after the forbearance period has ended. If you cannot afford regular payments after the forbearance period because your household income is not back to where it was pre-pandemic levels, a modification might be the option. The modification rolls missed payments into the principal balance and may reduce the interest or extend the loan term and then defer those payments of some portion of the new principal. You should apply for modification before your forbearance period ends, and help is available for that. Modifications aren't guaranteed, but if you have submitted an application post forbearance, no foreclosure action can be started against you as long as your application is being reviewed. At-risk extension, these apply to reverse mortgage assistance. For reverse mortgage borrowers age 80 and over, after forbearance, if your servicer has paid your property taxes and or homeowners insurance, it can declare default and start a foreclosure action on your reverse mortgage. Applying for an at-risk extension prevents a foreclosure for a year. You can apply for renewal. The application is pretty easy, but requires you submit a letter from your doctor stating that it would be unsafe medically for you to be displaced from your home. Bankruptcy is another option. Bankruptcy may be a good post-forbearance option for many borrowers. There's a new streamlined bankruptcy process for small business owners called Subchapter 5 of Chapter 11. It is available only until March 27th of 2021. If you are considering bankruptcy, consult a lawyer who can assess whether you are a good candidate. Free legal services may be available. And so here are some frequently asked questions for forbearances. Can I get a forbearance if I've been in foreclosure? If you're in foreclosure, unless you have been offered a trial modification payment plan, you ordinarily wouldn't be making payments anyhow. Servicers typically reject payments after starting the foreclosure process. And what if I'm in a trial modification plan? There is no prohibition on getting a forbearance after accepting a trial plan. Post forbearance you may need to submit a new application. And can I get a forbearance if my loan was just modified? A recent modification is not an obstacle to a forbearance, but a new modification forbearance may not be available. Can I refinance my loan after forbearance? You may be able to refinance, but the new potential lender will likely require at least 3 months of time before forbearance payment to consider an application. Will a forbearance harm my credit? Mortgage servicers are required to report forbearances to the credit reporting agencies, but if you were current before your forbearance, your loan will not show up as delinquent, and a forbearance is less harmful to your score than missed payments without a forbearance. What if my servicer won't give me a forbearance even though I have a COVID-19-related hardship? You can submit a complaint to the Consumer Financial Protection Bureau, the Department of Financial Services, or the New York Attorney General. Who owns your loan will determine which agency can best respond to your complaint. Next slide, please. What if my servicer won't extend my forbearance even though I'm still suffering a hardship? You can submit complaints. What if my servicer is demanding a lump sum repayment of my forbearance payments and I can't afford it? Again, you could submit complaints. And that concludes our presentation. I know we are going to stay around to answer any questions if there are any.
Yeah, we can answer any questions that you all have, or any other participants have questions.
Yeah, I was gonna say, 1 second. Thank you so much, ladies. That was really great. Very informative, very thorough. I know that I learned a lot. I don't currently own a home, but if I did, this is great advice for really anyone that's struggling right now, as I know so many people are. So thank you so much. That was great. Thank you. I know Peter wanted to say some things. Peter, if you'd like to take the floor for a second about COVID-related issues when buying a home or being a homeowner.
Thank you. And I needed to put on a mask because I have some technicians in my home. But Sara and Azalea, Staten Island Legal Service, you did a great job with the presentation. I thought you were spot on. Just to elaborate on a couple of your points, in order to refinance after you've gone through a forbearance, it is 3 months, as you said, for conforming loan sizes. And if it's a jumbo loan, they are requiring 6 months of payments back to a normal repayment schedule. TD helped forbearances for many, many people and still is. And thank you for reminding us of the deadline for that. And it does not affect your credit scores, although it does show up on your credit reports because I have seen them during my work helping the borrowers. TD has helped hundreds of people who are current on their mortgages to restructure them. We call it a modification, but it's a little different than the modifications you were talking about. These are for people who have kept their employment, have the ability to repay, and we simply lowered their interest rate and payments to make it easier for them going forward and at no cost. Some of the other things we've seen COVID related, if you're self-employed, there's extra attention. Now, as you may know, borrowers, mortgages are income related, income derived really. And so there's a lot of attention around your salaries or whether they are from, you're an employee of a company or whether you are self-employed. If you're self-employed, there's extra attention around 2020 year-to-date profit and loss, because we're going to the underwriter is going to want to see that your income is strong and on par to what you have earned in prior years. If you're a salaried employee, it's a little more straightforward, but there will be scrutiny to see that has your employer required you to take a salary cut due to some of the hardships they may be experiencing due to a downturn in business. We also have seen something that's come forward in COVID, virtual closings. Where you can close via a Zoom meeting like something we're doing today. It does put some of the pressure on the borrowers with the documentation, because you have to arrive at the virtual closing with a full set of paper documentation and then overnight mail it to the settlement agent. But it is possible to do a virtual closing if you feel it's unsafe to attend, even with PPE. As far as appraisals, we are seeing more desktop appraisals or drive-by appraisals. meaning that a traditional inside appraisal where the appraiser goes into the property and inspects have now in some cases been replaced by a desktop appraisal. Okay, and also something to expect, shorter expiration dates for income and asset documentation. In other words, we're going to need current pay stubs right up to the final month that you're planning to close. We're going to need bank statements right up to the date of pretty much of your closing. It's just something that banks, real estate is moving forward, and many people are buying homes, but there are some overlays due to the pandemic. Again, I wanted to thank Sara and Azalea and Staten Island Legal Services, and you, Jill. It was a wonderful presentation. I learned a lot too. Thank you so much.
All right. Well, I think that was really great, Peter. Thank you so much for your input. Very, very helpful. Alrighty. So if that's it, I think we can close out the webinar. Sara, Azalea, that was awesome. Thank you so much for your time and energy into putting that presentation together. It was really great. And the Chamber appreciates it so much, me speaking as the representative. But again, thank you girls so much. And I hope to work with you guys in the future. That was really great. So on the ball, Peter, thank you. That was awesome. And this is also the last TD Bank and Staten Island Chamber of Commerce workshop that we're doing for home buyers. So yeah, that's about it. These will all be posted on the Chamber YouTube, and they're also available for viewing on the Chamber website. The recordings are all up there from the whole series. So thank you so much, everyone. Please have a great rest of your week. Stay safe. Happy holidays. You know, celebrate safely in your home and with your loved ones if possible. So thank you so much, everyone. Thank you.
Thank you.
Thank you.
Thank you. Bye-bye now. Thanks, everyone.